This video is to help you through problem 2.1 of the problems in chapter 2, the first problem. And I'm going to walk you through all of the transactions, and I'm going to talk my way through them, hopefully helping you get a good grasp on this chapter. So this is from page 44 in your textbook, and I can't remember now the page in the study guide, and I don't have my study guide paper handy, sorry. Okay, so to begin with, looking at the items they've laid out, you can see that there are 4 assets. We're going to be dealing with cash, accounts receivable. That's when your customers owe you money for service you've already provided for them. Supplies and equipment, all assets, things that you could turn into cash. On the other side of the equal sign, you've got liabilities, which in this case you only have one, and that's typical for our textbook, is we're only going to have one liability, and then accounts payable, and that's when we owe money to a creditor, someone who we've purchased something from and not paid cash immediately. For example, perhaps we went to Staples and we bought 3 new desks and 3 new chairs and 3 new computers, and we are going to pay for that over time or a little bit later. Okay, and last is owner's equity. That's the money that the owner of the business has put into the company at the beginning, and then when we make money over a period of time, like a month, then we add the money that we make to owner's capital, owner's equity. Okay, so let's look at the first transaction. The owner invested $97,000 in cash to begin the business. So whenever you see the word cash, that's a no-brainer. You're going to be affecting the cash account. So we're going to be adding $97,000 to our cash account, and we're going to be adding $97,000 to our owner's equity. Okay, this isn't truly a transaction of business, it's just the starting of a business. Okay, now we're going to add plus signs and minus signs when needed. Now, double entry accounting means that we're going to put the same number in 2 different places so that we have a way to check and balance our books. If you are putting, if you're crossing the equal sign of the formula, the equal sign goes here. If you're crossing the equal sign, your plus on the left is, your number on the left is going to be a plus, and your number on the right is going to be a plus. You will see in a second that we'll do some transactions that are all assets. So one would be a plus and one would be a minus. Our accounting formula has to always equal. So that's the reason for that. This is going to make more sense the more you practice it. Okay, transaction number 2. We paid $19,750 in cash for the purchase of equipment. So cash is easy for us to think about. We can figure out by reading a transaction if we gained money or lost money. So in this case, we paid money out. So we paid cash out. So that's negative $19,750. And we purchased equipment. So here's an example of we are using 2 asset accounts. We take money out of cash, but we add equipment. Okay. Number 3, we purchased additional equipment for $14,400 on credit. That means we didn't pay cash immediately. We're going to owe that company later. So we are going to add, was it equipment? Yes, number 3, we are going to add equipment. That was $14,400. And we're paying later, that's a liability, so it's accounts payable, and we're adding to our liability $14,400. Notice plus plus because we're on 2 different sides of the formula. Okay, number 4, we paid $11,800 in cash to creditors. Okay, so money left. So we paid $11,800. Now creditors, those are the people that we owe money to in our liability, our accounts payable. So we are reducing the amount that we owe our creditors by $11,800. All right, number 5. The owner made an additional investment of $30,000 in cash. All right, so we are going to add $30,000 of cash. And this is just like when we started the business with the $97,000. We're going to go straight over to owner's equity and add $30,000. Okay, number 6, we performed services for $8,200 in cash. So cash, that's an easy one. So we add cash, $8,200 in cash. And we performed, let's see, we performed services for cash, so that would be revenue. And this particular problem doesn't have a separate column for revenue, but revenue falls under owner's equity. So we would add revenue and we would subtract expenses and think of those as being kind of a subset of owner's equity. So we're going to add $8,200. Okay, that one is a little bit different. So to me, it's easier when you actually have the revenue and expenses showing up, which we will on one of our other problems. Okay, number 7, we perform services for $6,300 on account. So performed services, we know that's revenue. So we're going to add $6,300. And on account means paying us later. And I know the book is not being consistent with the way they're saying this, on account, on credit. They use other terms too. Creditors. They want you to know all of the different ways to say this. So we performed services for $6,300 on account. We get the $6,300 in our capital through revenue, and our customer is going to pay us later. That's accounts receivable. That's someone's going to pay us on account. All right, number 8. We paid $4,000 for rent expense. It doesn't say cash, it's implied. So we paid $4,000 out. It's an expense, which is a subset of owner's equity. So we're going to subtract $4,000 out of our owner's capital. Number 9, we received $3,500 in cash from credit clients. So I always start with cash. It's just easier. We know we're getting it or spending it. So $3,500 in cash we gained, and it was from our creditors, which is accounts receivable. So we are reducing the amount that people owe us in this case. Okay, next, number 10. We paid $6,460 in cash for office supplies. Another easy one. Start with the cash. $6,460 in cash, and we bought office supplies. $6,460. We're using both assets, so that's why there's a plus and a minus. Same thing last transaction, a plus and a minus. Okay, and the last transaction, the owner withdrew $9,000 in cash for personal expenses. So we're going to take away $9,000. Now this is a little bit of a trick, and down the road you'll see how we have to keep track of this very carefully. This is a personal expense. So that's a drawing of the owner's capital. So it's not an actual business expense. It's just the owner saying, hey, I'm going to take some money out of this business for my own personal use. It's called a drawing. And so that reduces the capital in the end for the company. Okay, and then totaling these guys all up, you need to, I guess the first one's pretty easy because you start with 97,000, subtract 19, subtract 11, add 30,000, add 8,200, subtract 4,000, blah, blah, blah. In the end, check your figures there and make sure you get 87,690 for cash. For accounts receivable, we only had 2 of them, so our balance there should be 2,800. We only had 1 supply, 6,460, and we had 2 equipment purchases for 34,150. Okay, our accounts payable, there were only 2 of them. The balance should be 2,600. And in the owner's capital, we should come up with 128,500. Now, we've got all the transactions looked at, and to double check our work, we should, whoops, stop inking. We should double check our figures and add together all of our totals on assets, and you should get 131,100. And then when you add together your liability and owner's equity, you should come up with 131,100. If both of those numbers turn out equal, you have probably not made an error. I say probably because there's a chance that you could have put something in the wrong column, maybe the wrong asset, and you would still come up with the right answer. But this is a quick way to just check and make sure you've got your accounting formula correct. All right, I hope that helps, and good luck finishing your problems.